Welcome to accounting systems. A lot of us, as we go through the accounting program, understand the ins and outs of the ways that financial activity needs to be reported, the way it needs to be classified, the way the debits and credits need to be recorded even. But a lot of times we don't think about the technology in place behind the accounting that we report on. So that's what we do in this class. So we've got accountant. So accountant, that's an O. On the one side, we've got technology over here. All right, so accounting, we've got the accountants, we've got the technology. And although we're not aware of it, many times we as accountants need to not only be familiar with the technology in place that's running our various accounting applications, we need to be experts in it. The accounting software itself, the networks and infrastructure that the accounting data traverses across. So increasingly, we as accountants are not only becoming just experts in the reporting, but we're becoming experts in the overall business of the organizations we're going in to evaluate and review. We need to understand how they work. So in order to be able to address those business needs or address clients' business needs, we need to understand how technology works in the business and also how information flows throughout the business to help make accounting decisions, to help make management decisions. Managements require accounting information as well, the management accounting side of things, to help determine how to drive the business forward. So if we think about from a technology standpoint, we've got our accounting information systems, AIS. But before we get there, we want to think about, well, what is an actual system itself? All right, so we've got systems, system. So a system basically can be defined as a group of things, an assemblage or combination of things, a combination of parts that form some kind of a whole, some kind of a more complex unit, if you will. So we think about accounting systems. Well, we'll get there in just a few minutes, but let's think about just systems in general. So we've got a system. We can have a system that is made up of parts. So think of your automobile. Your automobile is a system that's made up of the engine, the cooling system, the drivetrain, the wheels, the steering column, and the steering wheel. All of those things come together, all of those components come together to create something that we can actually use and transport ourselves down the road. All right? Human body is a system made up of a bunch of other systems. So we can have systems that make up a bigger system. So when you have a system that's made up of smaller systems, then you've got what are called subsystems. So subsystem. And you can think of the human body and some of the subsystems we have. We have the respiratory system that helps us breathe, convert the oxygen in air into our bloodstream. We've got the circulatory system that gets the blood all over our body. We've got the digestive system. We've got the lymphatic system. We've got our nervous system. All these systems come together to form the human body. Going back to the transportation mode, we've got a system of highways throughout our nation, the interstate highway system being a big example of that. Each interstate highway, for instance, I-55, could be considered a component of that interstate system, and you bring all of those individually numbered routes together, you've got a network, basically a system of highways that go and take you from wherever you are to wherever you need to be in the country. and you can include the state highways into that. But even in I-55, you've got I-55, and then you've got, say, the Batesville interchange. So that interchange has a number of road segments associated with it that all come together to get people on and off the highway. So systems and subsystems. Important consideration with regards to how the system works, how the accounting system works from an overall standpoint. So an accounting system, well, an accounting system is basically the system or the way that we collect and organize information as accountants into the financial statements, the account balances, and whatever else that we're accumulating that needs to be reported or that we use for reporting. So we've got an AIS that we can actually define as a system that records, processes, reports on transactions to provide financial, non-financial information that we use to make decisions and fulfill financial reporting obligations. And we also want to make sure that we have a good set of internal controls surrounding those systems. So AIS is fundamental to accounting. All companies, from your mom and pop stores all the way up to your global companies, use accounting systems, accounting information systems of some sort. So as we continue thinking about systems, we're going to continue to use some of the companies that are presented in this text as examples to think about what they would need, what they're going to use. So you think about, for example, Starbucks. What kind of systems are they going to need? What kind of information are they going to track on their systems? And what does management need to know that the system can hopefully provide for them? All of those can be part of what's taking place. So let's think about the accounting cycle. You should be familiar with it now. You've been through it in a couple of your classes. So we start with some kind of an event, a business event or an economic event for a true accounting journal entry. Then we post that journal entry to our accounting journal. From the journal we go to the ledger, and then from the ledger we can create the financial statements. So the four basic steps of the accounting cycle. And basically we've got the journal that's organized chronologically. So it's by date and time. You can think of it as a sequential entry of items, more or less like a diary. So a journal, you think of a personal journal that you make entries to in a sequential basis. There you go. Then we post. Basically posting is resorting the transactions into a ledger which is organized by account. So we can take any particular account, whether it be our cash account, our receivables, our payables, and then figure out how they have been affected during whatever period we're analyzing. From there we create various reports, trial balances, we make adjusting entries, we adjust that information, we eventually close the books, and we're able to create our post-close trial balances and other financial statements that we send out to various recipients. So let's think about a basic information system. What are the components we need to have an information system? Well, we need some kind of input. We need to collect some kind of data, some kind of input that we can use to process information. So once we've got that data that we've collected, we can start processing it, doing something with it, and then we have to have an output, some kind of an output that we use for the data that has been processed. Now, most information systems don't run in a vacuum, so we need to be able to store the data. So here are the basic components of any information system. We've got input, process, output, and storage. So the input might be the sales that we have at the counter of a Starbucks, for example. So every snack, every beverage someone buys, they ring that up and it gets collected. That's the data. That data gets processed initially just to store it in the general ledger as a transaction. Additionally, at the end of the day or at the end of the week or month, we may want to do a little bit more processing with it and come up with some kind of a query that says, well, what are the best-selling items we have that sell, say, in the evenings? So that they can maybe change the way that the store display is laid out in the evenings to sell, different snacks at a better rate. And then the output for something like that would be the report, a report of what's the answer to that question, what items are selling best. And for just the basic transactions, a transaction listing by date and time could also be an output. All right, so we've got a basic information system here. And we've got internal data sources. You think the clerks at the counters that are inputting the transactions, you've got basic output users, internal users, managers are looking at what's selling, what's not selling to determine what to buy. All right, so here we've got the information system as used within the business organization. But we also have external data. So we've got external data sources. So we've got information that you and I, if we've got one of their cards that we plug into their system to determine, to get our Starbucks rewards. They have also suppliers and maybe retail supermarket customers that sell their products that are going to input data into their systems as to what they're selling. That also maybe for the suppliers input data as to what their current prices are. External users as well. We will log in and see what our balance is on our Starbucks rewards, whether we need to refresh our card, etc. And then another important component is the feedback. What kind of feedback comes from external users, internal users, to determine what is it we need to change about the way data is collected or processed to make better decisions in the future. So that's the basic information system viewpoint. So an IS, one of the things that needs to be emphasized is an IS does not necessarily need to be computerized. So the information system is basically an integrated set of components that we have for collecting, storing, processing, communicating information. So if you think about it, a book itself can be an information system. We've got a book, it's organized, it's got the words, it may be organized into chapters, sections of chapters, etc. And it's designed to convey information to us, and then we process it and use that information, and the book may help us in the case of this course or other courses, learn something. One of the most important things to consider when thinking about information systems is the information itself. Why build an information system if the information you're getting out of the system isn't useful? One of the things we want to think about is what actually makes useful information. And there are a number of attributes. Useful information. Useful information. So how do we know if information is useful? I love my straight lines there, by the way. We kind of have an intuitive knowledge or an intuitive understanding whether information is useful, but we need to formalize that a little bit more. So we can take a couple of attributes of information to determine whether indeed it is useful. First one is it relevant? If I could spell, relevant. All right, so relevant. What do we mean when we say relevant? Well, the information has to do something useful for us, and it also has to apply to the decision we're going to make. So does it give us some kind of value in predicting the future, say, or in understanding the past, or in providing some feedback for activities that we have performed previously? Another aspect of relevance is it timely? information that we get might be predictive. It might give us feedback, but it might be from so long ago that it's predicting a time period we're no longer interested in. So relevance is one of the key aspects of information that we want to consider. The second one would be reliability. So is the information reliable? So relevant information, if I go to the track to watch the horses race, well, you get those tip sheets. You might have somebody come, hey, psst, I've got some inside information on one of the horses. And of course, the same thing would apply to the stock market. How reliable is that information is the other key consideration. I can give you a tip. It's timely. It might be a predictive tip, but how reliable is it? Can we verify that information? Is there a way to verify that information? That would be one way of determining its reliability. Does it represent what it's purporting to represent in a faithful manner? So, the cash balance or receivables, is it really reporting what people actually owe from a legal perspective? And then neutrality. Would I take a look at this, and would someone else, maybe a disinterested party, come and take a look at this same thing and come up with the same information? So useful information needs to be relevant and reliable. Data versus information. It's important to think about what do we mean. You'll hear data processing, you'll hear information systems. The terms are sometimes used interchangeably, and to a great degree they convey the same type of thing. But if we think about them from an information system standpoint, the data itself are just the raw facts that come in. Maybe the transactions that are recorded from the point of sale terminal, where the information are the graphs, charts, the reports, maybe some analysis that takes place based on that data. So the processed data that allows us to help make decisions. So as part of the processing, it could be as simple as just organizing it some way that's meaningful to us, rather than just looking at a bunch of transactions that happen one after another. So the easiest example you can come up with there is posting to journals, posting to ledgers. So posting, reorganizing by account number allows us to get a better picture of what's taking place in the company than just looking at individual transactions. Sales price of an item could be a piece of data, but how profitable is that item? So that's where some of the cost accounting information, how we've calculated what the cost of goods sold is going to be, to come up with some kind of a net margin, tells us how we are doing with the sales that we're making. One of the terms you'll hear frequently is information overload. And especially in this world of big data, where companies like Starbucks, companies like Amazon, companies like Walmart are accumulating millions and millions of transactions every day. The amount of information that they have and need to be able to analyze is humongous. So information and the number of different ways that it can be organized, reported, charted, graphed are just innumerable. So information overload is basically due to the idea that we have all this information available to us, but what's the right information we need to make the right decisions? So it's important to think about that as you review the systems in place at the businesses you go and visit, and possibly if you get to the point where you might be designing systems. The information value chain, but it's an important thing. The value chain is something that we are starting to think of from an accounting standpoint. What kind of value are we adding as accountants, especially as companies try to mind the amount of money they're spending in a number of areas. So you've got value chain where businesses determine, well, what's our need? Business need. And what are the business events that take place? And so those come together and provide the data that we use to process what's taking place. We're going to convert that data through a variety of processes into information. And from that information, we can build what we call organizational knowledge. Knowledge about what that information means for us as a company, for us as an organization, and then make the appropriate decisions. What kind of, I don't know how to spell, what kind of new products do we need to roll out? What kind of products maybe are not doing as well? Are we doing different things in different regions, and do we need to react in various ways? So the information chain, the value chain, becomes an important part from an accounting perspective as well as from the organization itself. One of the last things we want to cover is discretionary versus mandatory information. So that's an important concept for companies, especially as companies operate in a number of different jurisdictions. So most companies that are multinational have to meet reporting requirements in all the countries that they do business in. So we've got discretionary, we've got mandatory. So discretionary information would be the information the company uses internally to make the important decisions going forward in business, whereas the mandatory information are the information required for that company to produce from a reporting standpoint, whether it be to stockholders, shareholders, from an SEC standpoint, filings that need to go to the taxing authorities, the IRS here in the U.S. So the important thing there is discretionary information is not required. Mandatory, obviously, is required. So we want to think about these in different ways. The mandatory information is required, so the idea or the objective for mandatory information is to minimize the cost in creating that information. For discretionary information, well, the objective is to create information that helps make better decisions, that's worth more than the cost to produce the information. So you can think of some of the types of discretionary you might run across are activity-based costing systems. Some companies have determined that the information that they can gain out of activity-based costing rather than standard costing is beneficial enough to them, it's worth enough to them that it's worth collecting that information because they can make better business decisions. For this type of discretionary information, management is the group that determines whether discretionary information should be created. Mandatory information, some kind of an outside body is generally going to require that as a cost of the privilege of doing business in that jurisdiction. So 10Ks for the SEC, tax returns for the IRS, and again, since these are required, the objective there is to minimize the cost.